Imagine two people, same age, same salary, same city. One of them spends hours every week researching stocks, reading earnings reports, watching financial news, moving money in and out of the market, trying to find the next big winner. He feels smart. He feels in control. The other person set up one simple investment 15 years ago, never touched it, and went back to living his life. Guess who ended up richer? Here's the part that messes with your head. It was the second guy, by a lot. And this isn't some rare lucky story. This pattern shows up again and again across decades of data. The person doing less consistently beats the person doing more. That goes against everything our brain tells us about how success works. We're wired to believe that more effort equals more reward, that expertise wins, that action beats patience. But money doesn't always follow those rules. Today, we're going to talk about the one investment tool that quietly turned ordinary people into millionaires. Not through genius, not through luck, but through something almost embarrassingly simple. It's called the index fund. And by the end of this video, you're going to understand exactly why it works, why most people avoid it, and why avoiding it might be costing you a fortune. Let's go back to the way most people think about investing. When someone first decides they want to grow their money, what's the first thing they think? Pick the right stocks. Find the winners, get in early on the next Apple, the next Tesla, the next big thing. And that makes complete sense. It's exciting. It feels like a skill you can develop. There's a whole industry built around making you feel like, with the right information and the right strategy, you can beat the market. So people start buying individual stocks. They listen to tips from friends. They follow finance influencers. They check their portfolio 12 times a day. And the whole time, they feel like they're doing the right thing. But here's a statistic that should stop you cold. Over any given 10-year period, roughly 80 to 90% of professional fund managers, people who do this full time, who went to elite schools, who have teams of analysts and access to data most people will never see, fail to beat the average market return. Let that land for a second. The experts are losing. Not most of the time, not half the time, almost all the time. So what chance does the average person have trying to pick winning stocks in between their job, their family, and everything else in life? This is the trap most people fall into. They think investing is about being smarter than everyone else. But the market is made up of millions of smart people, all competing. When you buy a stock because you think it's going to go up, you're betting that you know something all those other smart people don't. That's not investing. That's gambling with extra steps. There's a better way, and it doesn't require being the smartest person in the room. So let's talk about what an index fund actually is. And we're going to start with a metaphor. Imagine you're at a pizza competition. There are 50 different pizzerias competing. You don't know which one is going to win. You could guess, maybe the one with the fanciest oven or the one that's been there the longest, but you might be wrong. Now, imagine someone offers you a deal. Instead of betting on one pizza place, you can own a tiny slice of all 50. If most of them do well, you do well. If one of them becomes outrageously popular and starts making incredible profits, you get a piece of that too. You're not trying to pick the winner. You own the whole competition. That's basically what an index fund is. An index is just a list. The S&P 500, for example, is a list of the 500 largest publicly traded companies in the United States. It includes companies like Apple, Amazon, Microsoft, Google, Visa, Johnson & Johnson, across every industry you can think of. An index fund is simply a fund that buys all those companies at once, in proportion to their size. So when you put money into an S&P 500 index fund, you own a tiny piece of 500 different businesses simultaneously.
You're not betting on one company, you're betting on the entire American economy. And here's the key question. Has the American economy grown over time? Over the long run, despite crashes, recessions, wars, and pandemics? The answer is yes. Consistently, stubbornly, almost relentlessly yes. The average annual return of the S&P 500 over the last century has been around 10% per year. That means money invested in an index fund has historically doubled roughly every 7 years.
Not every year. Some years it goes down. Some years it goes down hard. But across a long time horizon, the trend is clear. Now here's where the magic of compounding comes in. And this is the part most people deeply underestimate. Let's say you invest $10,000 in an index fund at age 25, and you never touch it. At 10% average annual return, by age 65, that single investment grows to over $450,000. You didn't do anything. You just waited. If you add just a few $100s a month on top of that, the numbers become almost impossible to believe until you see them on a calculator. This is why people call compound interest the eighth wonder of the world. It doesn't care how smart you are, it just rewards patience. Here's where we need to talk about something deeper. Because understanding how index funds work isn't the hard part. The hard part is understanding why most people still don't use them. And the answer is psychological. Our brains are wired for stories. We don't get excited about slow and steady. We get excited about the dramatic win. The guy who put $5,000 into a startup and turned it into $1 million. The investor who bought Bitcoin at $200. These stories spread because they're thrilling. Index funds don't give you that story. There's no exciting moment. There's no genius play. There's nothing to brag about at dinner. And we're also wired to feel like we need to be doing something. Sitting still while your money quietly grows doesn't feel productive. It almost feels lazy. So we convince ourselves that more action, more research, more trading must lead to better outcomes. There's actually a name for this in behavioral finance. It's called action bias, and it's one of the most expensive cognitive traps investors fall into. Studies have shown that the more frequently people check and adjust their investments, the worse their returns tend to be. Every time you react to a market dip by selling, or to a news headline by shifting your money, you're almost certainly doing more harm than good. Fidelity actually did an internal study looking at which types of accounts performed best over a long period. You know what they found? The top performing accounts were ones belonging to people who had forgotten they had the account, or people who had passed away. The investors who did the best were the ones who did absolutely nothing. That sounds almost offensive. Like, that can't be right. But it keeps being right, over and over. There's also the cost problem. When a professional fund manager is actively buying and selling stocks on your behalf, they charge fees. Those fees might sound small, maybe 1 or 2% per year, but over 20 or 30 years, 1 or 2% shaved off your returns every single year adds up to an enormous amount of lost wealth. Index funds charge almost nothing because there's no active management. No one is making big decisions. The fund just mirrors the index automatically. Some index funds charge less than 0.1% per year. That difference in fees alone can mean hundreds of thousands of dollars over a lifetime of investing. So what should you actually do with this information? First, start. That's the most important thing. Time is the engine that makes all of this work, and the longer you wait, the less time that engine has to run. Second, keep it simple. You don't need a complex portfolio of 30 different funds. A single broad market index fund covering the US market or a global index fund is enough for most people to build serious wealth over time. Third, automate it.
Set up a recurring transfer every month so money moves into your index fund automatically without you having to think about it or make a decision. This removes emotion from the process. You buy more units when prices are low and fewer when prices are high. This is actually a strategy called dollar cost averaging, and it smooths out the volatility over time without you having to do a single thing.
Fourth, don't touch it. This is the hard one. When the market drops 20% and everyone on the news is panicking, the worst thing you can do is sell. Historically, the market has recovered from every single crash it has ever experienced. The people who sold during a crash locked in their losses. The people who held on, or better yet, bought more, came out far ahead. Your portfolio dropping in value feels terrible. It triggers real anxiety. But a drop in paper value is not a real loss unless you sell. The number going down on your screen means nothing if you don't react to it. And finally, understand what you actually own. An index fund is not a magic box or a financial trick. It's ownership in real businesses. When you own an S&P 500 index fund, you own a piece of hundreds of companies that wake up every morning and try to solve problems, create products, and generate profit. You are a part owner of the economy. And over long time horizons, economies tend to grow. Here's the thought I want to leave you with. The most sophisticated investors in the world, people like Warren Buffett, who is arguably the greatest stock picker in history, have said publicly that ordinary people should simply put their money in low-cost index funds and leave it alone. Buffett even famously made a $1 million public bet that an index fund would outperform a hand-picked portfolio of hedge funds over 10 years. He won. The most complicated, resourced, high-powered corner of the financial world lost to the simplest possible strategy. Investing doesn't have to be a full-time job. It doesn't have to be stressful. It doesn't have to involve reading thousands of reports or timing the market or trying to outsmart everyone else. Sometimes the smartest financial move you'll ever make is the most boring one. Set it up, leave it alone, let time do the work. The person who got rich quietly while doing nothing exciting, that person can be you.